You know the deal with tech stocks, right? On one hand, you've got this absolutely world-changing growth potential. It's incredible. But on the other hand, you're often looking at terrifying volatility and, well, not much income to show for it. It really is a classic high-wire act for any investor. Okay, let's just dive right into the heart of the problem. Think about the absolute titans of tech, right? The Magnificent Seven. These companies have built trillion-dollar empires on pure innovation. But what happens when it's time to share some of those profits? Well, the dividend yields are often zero, or so small they're basically just a symbolic gesture. If you want cash from these giants, you literally have to sell your shares. And that kind of feels like you're selling off a piece of the engine just to get some gas money. And that, right there, creates this huge conflict for so many of us. We're basically forced to make a choice. Either you jump in and participate in the future of innovation, or you build a portfolio that gives you a steady, reliable income stream. It always feels like you just can't have both. But hang on a second. What if that choice is a false one? What if you could actually bridge that gap? What if it were possible to invest in this incredible tech renaissance and still collect a meaningful paycheck from your portfolio? Well, that is exactly what we're going to dig into today. We're looking at a different way to approach technology investing, one that puts stability and income right up there alongside that all-important innovation. All right, so let's pull back the curtain on our subject. It's called GPIQ, the SPDR S&P Global Technology Dividend ETF. And its entire mission, its whole reason for being, is to solve the very problem we just talked about, to connect that exciting, mind-bending growth of Silicon Valley with the steady, income-focused discipline of Wall Street. Now, I gotta say, the way our source material describes this strategy is just perfect. I love this quote. See, this isn't about chasing the hottest, most speculative new thing on the block. It's about finding those mature, stable tech companies that have already figured out their business model and are now in a position to share the profits. So the big question is, how does it actually find these companies? It's not just some fund manager throwing darts at a board, right? No, this fund follows a really disciplined, rules-based approach. It all boils down to this really simple three-step screening process. First, it casts a wide net, looking at the entire global technology sector. Then the first filter goes up. It searches for companies with a rock-solid dividend history. We're talking at least 7 straight years without a single cut. And finally, it does a health check. Opens up the books to make sure these companies are financially strong, with good returns and debt they can actually handle. It's tech, but with a safety net. And who actually makes the cut? Well, you're going to see names like Broadcom, Microsoft, and Texas Instruments. These are not speculative startups. Our source calls them tech landlords, and I think that's brilliant. They own the essential infrastructure, the digital plumbing of our age, from semiconductors to networking gear. They're the ones collecting rent on the digital economy. And here's a really key point. GPIQ isn't just focused on Silicon Valley. It's a global fund. Yeah, about 55% is in the US, but a huge chunk is over in Asia and Europe. This gives you a crucial layer of diversification. Plus, as our sources point out, a lot of tech companies outside the US, like a Samsung or a TSMC, often have a much stronger culture of paying out dividends to their shareholders. Okay, so we've seen the how, but what about the why? What's the actual bottom line for you, the investor? This is the what's in it for me part. The headline number, the one that makes you sit up and take notice, is the yield. It typically sits in that 3.5% to 4% range. Now, for the tech sector, a number that high is, well, it's kind of like finding a unicorn. It's a substantial income stream that's backed by real cash flow, not just hype. And just to really hammer this point home, look at how it stacks up against the really popular pure growth tech ETFs. You take something like QQQ, which tracks the NASDAQ, or VGT, which covers US tech. The difference is just staggering. It's not even close. We're talking about more than 5 times the income. But wait, it gets even better. And this is a really crucial point. This isn't just a static payout that stays the same year after year. The companies inside this ETF have a history of growing their dividends over time. So the goal isn't just to give you income today, but to give you an income stream that actually grows and helps you fight back against inflation down the road. Okay, now let's be real. No investment is a magic bullet, and to be prudent, we have to talk about the potential downsides. And we've got to see how this thing really stacks up against the competition. So it's really important to remember, at the end of the day, this is still a tech fund, and that means it's exposed to the natural boom and bust cycles of the tech industry. It's also heavily focused on semiconductors and hardware, so if that sector gets a cold, this fund is definitely going to feel it. And because it holds global stocks, currency fluctuations can play a role. And, of course, even the most stable companies aren't completely immune to a deep recession. And this table just lays it all out so clearly, doesn't it? It shows you exactly where GPIQ lives in the universe of ETFs. Look, it's not trying to be QQQ, that's all about high-octane growth and high volatility. And it's not trying to be a broad U.S. dividend fund like SCHD, which has very little tech exposure. GPIQ carves out its own unique little niche, a meaningful chunk of tech combined with a seriously high yield. All right, let's bring it all home. When you put it all together, who is this kind of prudent tech strategy actually for? Well, this approach is pretty much tailor-made for anyone who wants to be in tech, but, can't stomach the wild roller coaster rides. It's for people who are building a retirement portfolio, who need that income, but don't want to completely miss out on innovation. And honestly, it's perfect for anyone who just likes the idea of getting paid, collecting a dividend check, while waiting for a turbulent market to find its footing again. I think this final analogy from our source material just sums it up perfectly. You're still on the express train, you're still heading toward the future, but with GPIQ, your journey is just smoother, more comfortable, and a whole lot less stressful. In today's market, it's so easy to get caught up in all the speculative manias. You could almost call this the anti-YOLO ETF, right? It's the complete opposite of that. It represents a deliberate choice to prioritize discipline over dopamine, to invest instead of just gambling. And that really is the core philosophy, isn't it? It all boils down to these three powerful ideas. You get innovation, but with restraint. You get growth, but it's backed by actual cash flow. And you're still taking on risk, but it's with reason. And that leaves us with a final, thought-provoking question. In a world that is constantly tempting us to chase the next big, exciting thing, this strategy offers a really compelling alternative, the quiet, consistent power of just collecting your returns quarter after quarter.